Well, bulls have been roaring across the screen. Fourth straight day of gains, and the US Fed maintaining its rate cut outlook for 2025 has provided the strength to the markets despite the tariff concerns that we had. Sensex surged 900 points while Nifty settled above that 23,190 levels. Nifty particularly crossed that 50 DMA levels. So on Tuesday, we saw 20 DMA, yesterday 40 DMA, and today it was 50 DMA despite the weekly expiry. Bank Nifty too crossed past that 50,000 mark, and now the 200 DMA level of 5950 level will be also watched out. Market breadth continues to remain positive. Advanced decline ratio at 2:1. All the sectors have traded in the green, and the leadership definitely came in from the financials and IT stocks and oil and gas stocks too. Reliance Industries and HDFC Bank, both of the index heavyweights, contributed the most to the market's up move. India VIX also cooled off below that 30 odd levels, and we can see broader end of the markets also fared well. Not that big of an outperformance like we saw yesterday, but quite well once again. Mid caps up about 0.6%, small caps also more than 0.5% gains, 0.7% uptick that came in. Now, if you pull up the top Nifty gainers and losers list, Bharti Airtel, the top gainer on the Nifty, up for the second straight day with about 4% gains. Titan also up about 3.5% gains coming in for Titan, and some of the auto stocks also did gain limelight. We can see the likes of Bajaj Auto, Eicher Motors seeing a gain of about 2.5%. BPCL also seeing good gains, about 2.5%, and Britannia also doing well with about 2.6% gains. On the other hand, if you look at the top losers on the Nifty 50, that includes the likes of IndusInd Bank. Well, after 3 days of advance, we can see once again, the IndusInd Bank has been flipped into the red with about 1.2% cut coming in. Other than that, we can see Bajaj Finance with about 0.5% cut, Trent also with about 0.1% cut. But without much further ado, let's quickly get on board with our market expert of the show. Joining me is Sandeep Agarwal, fund manager of Sovilo Investment Managers. Sandeep, good afternoon. Fourth straight day of gains for markets. Do you believe that the markets are better placed now in terms of valuations, what it means, 2-3 months back, or is there still some froth left? Okay, we'll just connect with Sandeep for a bit. There's a bit of a lag at this point of time, but like I was talking about, that IndusInd Bank, some of the top losers on the Nifty 50. But yes, Sandeep, once again back with us. Sandeep, as I was talking about, fourth straight day of gains. So do you believe that the markets are better placed now in terms of valuations and what it was 2-3 months back, or do you believe that there is still some froth left?
So, good afternoon and thanks for having me on the call. So, there were 3-4 things which were, impacting the market a quarter back. One, market was slightly above reasonable valuations, and there was some froth in mid cap and small cap, which needed a reason to have correction. That was number one. Number two, we saw that, the capex spend from government has come down because of the elections and few other things. Thirdly, we saw that there was a lot of liquidity issue also, and moreover, Trump being appointed president and tariff wars and not pulling off of Ukraine, Russia. So everything came together. There was no sign which was indicating that market could remain here. And now, if you see in last 1.5 months, we are seeing markets have broadly corrected by 15%, which is a decent correction for Nifty broadly, and for mid and small cap it is upwards of 20%, which is a very good correction in my view, followed by injection of liquidity by RBI. Additionally, we are seeing that the tariff chance has also come down a little bit, and we are also seeing early signs of some kind of settlement between Ukraine and Russia. So if you see, everything which was a concern just 2-3 months back have fallen in place. So I think now markets are looking very good, and the stocks where there is no fraud, where the valuations are decent, and where the numbers will come, I think those stocks will recover very fast. And I believe that it will not be a fall everything market going forward. Rather, it will be selective up moves for companies which are doing well, which are going to report good numbers.
Okay, okay. Sandeep, reciprocal tariffs, however, from next month onwards, it's also playing one of the key hindrances for the markets. But what if the reciprocal tariffs are announced by the Trump administration? What kind of, correction would you expect to see? Because so far till now, markets have been discounting that because there has been no clarity on that front, that how much of an imposition of reciprocal tariffs would be, what it would mean on India, how many products are going to be taxed. So, what do you expect on that front?
So, tariffs generally are inflationary in nature, and also finally they will cut the whole purpose, or dilute the whole purpose of imposing tariff, because dollar will appreciate. Dollar will appreciate if US starts imposing heavy tariffs. So the uh, purpose of imposing tariff will be completely filed, because then the currency, again the country against which you are trying to impose the tariff, that country's currency itself will depreciate, and it will mitigate the impact which you should get. And ultimate loser will be the consuming country's customer, and it will reflect in inflation. So you will be in a situation where inflation will not come down and growth will also fall. So I think that situation had also started reflecting in discussions in US, and I think there will be more measured call on that. That is number one. Number two, I think from India perspective, if you see, we are not exporting too much in terms of goods. We are exporting a substantial amount of services also. So for us, yeah, obviously it will be bad for some industries, and it will be there will be some panic. But I don't see a big risk of tariffs on India compared to China or some other countries. That is my view, and I believe that the tariffs will also be more measured, and the actions going forward, you will see more measured actions rather than very strong actions. That is what my view is, because you know US is also aware that some of the countries may put reciprocal tariffs on them as well, and also the supply chains will get disturbed. Also, some of the major US players who are selling their products in China and other markets, they will also see backlash. So, and we have started seeing some of them in some select markets. So I think it will be more measured impact rather than a hard landing kind of thing.
Okay, okay. So Sandeep, what does it mean for FIs? Because on one hand, you're saying that the Chinese, the China market could be seeing facing a larger bit of a tariff war here on. So what does it mean for FII? Because last days of data, we saw that a recent bit of data reversal, some signs of reversal was showing in. But from here on, what do you expect? Do you expect the flows to come back to India or to go to another developed economies, or what are you expecting?
So I would put it this way, that again, going back 2-3 months back, what was also happening was that because dollar was strengthening, so the returns in dollar terms were further going down for India, and also people were trying to move to safe haven. So there was massive FI outflow. I think with now recession fears knocking on US doors, and also people seeing that tariff is not good for everyone, all those things, and more rationality returning, what is happening is that I think the intensity of outflow of money from India is reducing, and incrementally, I think that will happen. Also, you have to see that mutual funds are sitting on very high and significant amount of cash. Markets are not expensive. So I would say that even if FI selling decelerates or the outflows reduce, the amount of cash which is there and the amount of money which is coming every month, that will be suffice to take the markets again back to normal levels or rational levels. So I am very constructive and positive. I think the correction which has happened is a bull market correction. I will not call it a bear market.
Okay. Sandeep, you mentioned that the cash levels are also quite high at this point of time. At as a fund manager, what cash levels are you sitting on right now? And if you had to deploy, have you started deploying right now, given the market recovery has been turning around?
So
What do you expect? Yeah.
we have started deploying very aggressively since 10th of March,
Hmm.
and we were at a good amount of cash, and we have deployed a large portion of that. Uh,
Hmm.
yeah, means we will have substantial amount of cash still in some of the new accounts which we are getting, but broadly in the existing account we were sitting on very good amount of cash around 10th of March. We have consistently been deploying every day.
Okay. Which themes are you finding attractive now, given that you have started to deploy cash too?
So we believe that there is a lot of good value right now in the cap goods. So we are very selectively picking up cap goods. We have also deployed in some of the good quality, reasonably priced pharma names. We have
Hmm.
also invested in private sector banks, selectively in some NBFCs, and in manufacturing always remains our very favorite segment. So there
Hmm.
also we have also put in the water theme.
Okay.
These are the broad and power ancillaries. So these 6 7 themes we have deployed. So now what has happened is that after this correction we have diversified more, because we have got better opportunity. Like capital goods was never there in our portfolio because it was always very expensive. So we
Hmm.
got capital goods as a new segment. Private sector was not where we wanted to buy. Now it has come to level where we were able to buy. So 3 4 sectors have added now. Earlier we were only investing in manufacturing, power ancillaries, and water theme. Now we have added additionally manufacturing and all this pharma and some IT names.
Okay, okay, all right. Sandeep, also, that brings me to another question that you said that, we have been, deploying more and more on capital goods, but everyone was banking on capex related plays to pick up pace and the capex spending to pick up. But right now, the spending still remains muted despite the FY25 capex was revised quite downwards. So, what do you make of that space? I mean, the spending is quite muted. Do you expect it to pick up at least in the next fiscal year, or what are you anticipating?
So I believe that the budget, the capex numbers in the budgets are quite good if you compare them with the actual numbers that have been spent. So we are very positively seeing that number. It is upwards of 17% growth, which is a good number. And the companies which we are selecting, the peg ratios are below one. So we are very comfortable, and we believe that capex as a theme, there would be some seasonality, but in a longer term, if you are buying at the right price, you will make good money. So we believe that this correction has given us the right entry price. Now obviously investments are a matter of patience. We have invested, we'll have to wait for few quarters before they reap results. So we have that patience because our entry points are good.
Okay, okay. Just to expand on that, Cindy, because everyone has been a consensus, bullish call on defense. However, railways have continued to remain quite expensive on that front. What do you believe? Despite the correction, how are you finding valuations of railways theme as a whole?
So we were very optimistic on railway theme a year back, 15, 16 months back, and we
Hmm.
invested substantial position in railways, and we exited when the valuations were very high.
Hmm.
We do have very little exposure now, but
Hmm.
not much.
Hmm.
We believe that now the valuations are better than what they were 3 months back, but they may
Hmm.
not be at the level attractive because the peg ratios are still more than one.
Hmm.
So for us, that number is very important. We are more optimistic on the cap goods, so we will try to play cap goods as a proxy rather than directly playing railways.
Okay, okay, all right. Sandeep, just shifting focus, we'll talk about a little bit about the wire and cable stocks because that was the major topic of the day. We saw that two big players have entered the segment, Birla Group and Adani Group also. So, what would be your advice be for investors who are holding the likes of KEI Industries, Polycab, RR Cables, and all of those segments? What are your outlines?
So, I would put it this way that it is very hard for me to comment on specific companies, so I will refrain
Hmm.
from that. But
Hmm.
let me give you a flavor that, the announcement and the actual, when it comes for competition, will take, 2 to 3 years. That is a fact. But at the same time, when you are in a monopoly position, then you get a different kind of multiple. And when a new entrant comes in, he comes in a challenger position. So,
Hmm.
your multiples, what you were getting earlier, obviously gets discounted. So I think right now, earnings are not at risk for any of them. But definitely, I think the multiple which everyone was assigning because of monopoly business, that multiple
Hmm.
will become more generalistic. And maybe, I think that 20 30% cut in multiple is what I'm expecting will happen, and I think a large part of that has happened. But still more can happen, because we have seen that in paint industry, we have seen that in gold jewelry industry, that whenever new player has come, it has disrupted because it comes as a challenger. So it takes
Hmm.
away your market share, it disrupts the price, it disrupts the margin.
Okay, okay, that's a very interesting take, Sandeep. But all right, with that, we have to let you go, Sandeep. But so happy to connect with you, and hope that we connect with you soon.
Thank you so much.
All right. With that, we have come to an end of this edition of Closing Bell. Thank you for watching, and stay tuned to moneycontrol.com for all the news updates and market insights. क्या प्रदीप